My body is a machine that turns extreme greed and your Patreon donations into capital gains for Wall Street investors. Despite many of you knowing this, you continue to encourage me to pursue the path of degenerate risk-taking by engaging with my content, as well as including some of your own uniquely noodle-headed strategies. While I admire the bravery and overconfidence I see both in the YouTube comments and in the Discord channel, I must say that one recent comment in particular has caught my attention. One of you geniuses wrote, "Why not just short a 3x long and 3x short ETF on the same underlying with option spreads so that volatility drag is your friend?" Now if that sentence sounded like gibberish to you, congratulations. You probably actually make money in the stock market.
Good for you!
But such profound words fill degenerate gamblers like myself with feelings of excitement. And while this is a nearly immaculate example of wrongthink, I can't help but engage with it and turn it into content. It's a sickness, I'm afraid, and it is terminal, at least for my bank account. Here's the strategy in a nutshell. Let's look at an example. For this example, we'll look at TQQQ and SQQQ. TQQQ provides 3x leverage exposure to the Nasdaq, while SQQQ provides 3x inverse exposure to the Nasdaq. So when one goes up, the other goes down. The basic idea here is to try to eke out some profit from the volatility drag inherent in these leveraged ETFs, particularly the inverse ETF, because that one is far more likely to decline in value over the long term for the simple reason that the Nasdaq, its underlying, goes up more often than it goes down. And after working on this piece, I honestly don't even know which way is up or down anymore. Before we talk about the strategy, we need a brief explainer on volatility drag. Volatility drag is generally a bad thing because it causes leveraged ETFs losses to compound over time. Because these financial instruments reset daily, it means that the more days in a row the underlying shares dip, the bigger the recovery needs to be in order for you to get back to even. In fact, a 2 or 3x leveraged ETF can, and often does, underperform its underlying assets, even if the underlying has gone up over a given time period. Here's some quick math to demonstrate how that happens. Let's pretend that we invest $3,400 in Intel, ticker symbol INTC, and another $3,400 in INTW, its 2x leveraged degenerate gambling counterpart. You hold these shares for 5 days, and Intel's performance is as follows. As you can see, you would have been better off just buying the regular old shares, at least in this scenario. Also, this chart doesn't include management fees, which can be quite high for leverage ETFs. So in the case of a dip, you should be prepared to lose more than 2x of your position's value.
Can I get a oh yeah?
I've looked at a bunch of these, and very generally, if a stock goes down, say 10% over the past 3 months, don't be surprised to see its leveraged counterpart down between 22 or 30%. Fairly warned BV. So volatility drag is bad, particularly for those who own shares of leverage ETFs or buy call options against them. I mean, you'd have to be a fucking idiot to do that. Volatility drag makes these sorts of investments unfit for holding long term, and they pretty much tell you that up front. Okay, so here's a strategy. Because TQQQ and SQQQ are inversely correlated, and because the stock market usually goes up, you'll notice that SQQQ, much like myself, basically does nothing but lose value over time. So how do we make money off this crap? There are many ways to try to do that, but let's first go over our commenter's suggestion, which was to buy put spreads on long and short ETFs covering the same underlying. We can do this with TQQQ for the long position and SQQQ for the short position. But that's kind of clunky to manage because it involves 2 different ETFs. There's a couple of simpler ways for us to potentially make money off volatility drag. First of all, you could buy a long straddle on just TQQQ, or you could just sell call credit spreads on SQQQ, the short ETF. The underlying logic here is that because the Nasdaq usually goes up, you can expect SQQQ to lose value over the mid to long term. So, selling call credit spreads on SQQQ could therefore be a way to capitalize on its tendency to lose value over time, both because it's fighting against forces that historically cause markets to rise in value, and because of our old friend volatility drag. Out of the 2 methods, this is the one I prefer, so let's talk about it some more. Since over the mid to long term an inverse leverage SPY ETF should go down, and because of the high volatility associated with these instruments, here's what we need to do. Actually, what we should do is deactivate options in Robinhood and go touch grass. But we both know that's not going to happen, so here's the next best thing. Okay, so what we're going to do is find a way to profit off SQQQ's long-term trend of losing money over time while being net sellers of premium rather than net buyers. This is because the high volatility of SQQQ means its options are more expensive. So buying puts or even put debit spreads puts you in the position of being a premium buyer. Instead, we want to sell call credit spreads on SQQQ. This strategy just focuses on one ETF, so you don't really need TQQQ as a hedge. Because when you sell call credit spreads, you've already got a built-in hedge, which is the long leg of your call credit spread. A call credit spread is basically a two-legged option strategy where you sell a call option, then buy another one at a higher strike price, both with the same expiry date. This results in a net credit to your account because the nearer the money strike you sold is more valuable than the further out of the money strike call that you bought. For example, let's say SQQQ is trading at $66 a share. If you sell a dollar-wide call credit spread with $70 and $71 strikes expiring in 14 days, you essentially put up $100 of collateral while simultaneously collecting premium for the spread between these strikes. Your short call with a strike price of $70 means you're willing to sell 100 shares of the equity if the price exceeds $70. However, you don't own any shares. So that's where your long call comes in. That's your $71 strike call, which gives you the right to buy 100 shares of the underlying security for $71. Since you're promising to sell 100 shares at $1 less than you're promising to buy them for, your brokerage basically locks up $100 in collateral, which is the difference between your call credit spread's two strikes. So today is December 7th, 2025, and in this scenario, it looks like we can collect maybe $15 for entering the call credit spread on SQQQ. You can try to manage this at 75% gains, but just know that the volume can be a little thin on some of these weird leveraged ETFs, probably because most people know better than to screw around with these things. But we're not most people. Play stupid games, am I right? The problem here really boils down to basic supply and demand. If everyone understands that shorting the short index ETF is a good idea, naturally the instruments available for degenerate retail gamblers to do that sort of thing are all going to be mad expensive. Personally, I wouldn't fuck with straddles on these because the price swing in the underlying that you'll need to end up in the green is going to be pretty big. If you do decide to try this, at least enter the straddle when the underlying's IV rank is on the lower side. At least that way you might be able to benefit from volatility expansion, which is what you'll need for this position to actually pay off. You'll need every advantage you can get. Seriously though, don't do any of this shit. We've touched on low options volume before, but don't underestimate the ability of low options trading volume to screw up an otherwise perfect trade. Because unfortunately for us, not everyone is a degenerate gambler, so trading volumes on leveraged ETFs can get pretty thin sometimes, especially the further out of the money you go. And that's a problem when it comes time to exit these ticking time bombs. In short, I need people dumber than I am to YOLO into these things and serve as my exit liquidity. Whereas, in reality, I am the exit liquidity for some smart investor on Wall Street who actually knows what they're doing. It's the investing food chain, ladies and gentlemen, and I'm somewhere in this area over here. Sometimes you have to remind yourself that there are lots of people in the investing world who are deeply competent and actually know what they're doing. Ergo, the market is definitely aware of our cute little plan to play volatility drag, and has therefore priced these options appropriately. You don't need to bust out the Black-Scholes option pricing model to see that these things are pretty damn expensive. And now for my mandatory disclaimer. As a reminder, I'm a degenerate risk enjoyer on YouTube and an aspiring cult leader, not a financial advisor, so I'm sure my plan has weaknesses and drawbacks. And while I've outlined a few, I'm sure some of you will take the initiative to poke even more holes in this little strategy and sink my dreams. However, I can say with some confidence that it's better than buying two put spreads on two different ETFs and hoping the inverse mechanics work out. There are just too many points of failure when trying to do it that way. And if I'm going to lose money anyway, I'd rather at least not overcomplicate the exercise. So you're better off just doing bull spreads on TQQQ or bear spreads on SQQQ. Actually, you're better off disabling margin and option trading in Robinhood. But again, we both know that isn't going to happen. So here's the big question. Will I actually be doing this? Honestly, selling call credit spreads on an inverse SPY ETF is something I've been wanting to try for a while. I thought about throwing up one position for each of the next 5 expiry dates just to diversify my exposure over time on this strategy. Because SQQQ does sometimes spike up in value unexpectedly, And obviously, if that happens on a shorter dated call credit spread, you're basically fucked. The very nature of SQQQ, being an inverse of the SPY, combined with its volatility drag, as a leveraged ETF, means your remaining positions that are further out have a better chance of recovering before their expiry dates. I really do want to try it, but I think I've used up my quota of cockamamie schemes this year. See my video on selling covered calls on Tempest AI's 2x leveraged ETF. So ideally, before I try this myself, I'd like to hear from some of you that have managed to do it successfully. Basically, I'm willing to be convinced into doing more financial self-harm.